Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is November 22nd, 10:30 in the morning here in the UAE, and we have Brent crude oil trading again a little bit unchanged, but climbing all during the week. We're now at 74.32, and momentum again seems to be lifted by the sort of growing geopolitical risk to supply infrastructure with the rising tit for tat between the Ukraine and its allies and Russia. And so there we have it, 74.28 on Brent. Let's go to this kickoff this morning in London with Adi Imsirovic, Director, Surrey Clean Energy and Senior Associate at CSIS. Adi, I wanted to get your thoughts on all things regarding the Ukrainian-Russian war and its current escalation, which is sort of bringing in the allies, i.e., the US and the UK, have allowed the Ukraine to utilize its long-range missiles to fire deep into Russia. Russia has retaliated with some, magic new weapon that they have developed. All in all, I remember over the years that we've been talking about this. At the early days, we said this could be a Bosnia type grind over the years. And your country tragically hit with that in the 90s. Nobody did very much, enough to keep it going, but not enough to solve it. Your thoughts on where we're at this moment, a few weeks before Donald Trump returns to the presidency and the conflict in Ukraine?
Good morning, Sean. Good morning, everybody. Yes, a difficult question. It is, and it is a pretty ugly war. It's turning into a very, very ugly war at the moment, where civilian targets are sort of quite actually deliberately chosen rather than just collateral damage. New weapons are being used. I think I'm just hoping that this is just a very short escalation because there is a transfer of power in the United States and there's a lot of positioning coming from Russia and of course Ukraine as well. So a decision by Biden administration is kind of last effort to show that they really continue to support Ukraine, which is fair enough. Europe, as usual, is not doing very much outside the UK. UK is doing quite a bit, actually. Heavy lifting, I think, on behalf of Europe. But I'm just hoping this is I'm not a military man, but it's prior to the winter, which is going to be very hard to sort of do much on the front lines. I think there's a lot of positioning prior to Trump coming in. So yes, it's volatile, it's very ugly, and markets don't like it. As you can see, it's been quite supportive for the markets. People are worried. It's not just the escalation of the conflict, but also internationalization of the conflict, with the Koreans coming in, Korean soldiers. The whole conflict. Some people are saying, again, I'm not an expert on this side of things, but some people are saying that Korean troops would not have come into Ukraine if it wasn't for Chinese consent. So there is obviously indirect Chinese involvement there, including, materials, weapons, and other things. So,
given all of that, Adi, do you think the current oil price reflects that scale of geopolitical risk? I mean, as you said, the internationalization of this conflict, we had the President Putin yesterday describing it as on the border of a global conflict. Does the price at 74 and change reflect the scale of what's at risk here?
I think it does. I do trust markets, and I think markets do their homework before they actually trade. So, as we've seen in the past, Ukraine has a potential to become ugly, but in the past has always been contained, and the Russian exports have continued simply because the allies, including the United States, have actually allowed Russian export to continue. Biden administration wanted Russian export to continue, to have cheap gasoline in the United States. So market still continues to believe that. Let's not forget OPEC is sitting on 6 million barrels of excess capacity. So, they could essentially replace Russian exports if it need be. So there's no shortage of oil, but certainly it's not bearish, Sean. So either way you look at it, I think markets are pricing it in well. It wouldn't be the end of the world if we lost some of these Russian barrels again due to some other sanctions or whatnot, but there is plenty of oil to replace it.
Let's go to Algeria, one of the OPEC plus countries. Shoaib Boutamin, energy advisor and CEO of Ranadrill Consulting. Your thoughts, just leading off from that, Adi made there, the OPEC excess supply is sort of the softening and the savior of all the issues, it seems. What it used to be, whatever the question, China's the answer. Now it seems that whatever the question is, 6 million barrels of idle capacity a day seems to be the answer. How do you think OPEC Plus are sitting, Shoaib, now 2 weeks, less than 2 weeks away from their next meeting and their next big decision?
Yeah, good morning, Sean. I think this is a very critical time for OPEC Plus because, at the moment, the OPEC Plus is cutting like 5.83 million barrels per day. And even that, oil prices still like between $70 to $80 for more than 4 months at the moment. So I totally agree with Adi when he said that OPEC Plus could really replace Russia in kind of oil supplies. I think that was really was a choice of Biden's administration, because if they didn't allow Russia really, if they allow it really to pump less, it means that OPEC Plus countries will replace that. So that's the scenario I think Biden administration tried to avoid, to not keep the OPEC Plus really dominate the market share. I think what's really happening at the moment, I have to say, it is a very critical time, because what we see at this day is we have like a glut of supply in the global market. We have slowdown in economic, let's say, of supplies let's say, slowdown of economic growth in China. But more than that, we have some countries inside the OPEC Plus at the moment. They are pumping more. And let's say, give you just an example of Libya. Just a few days ago, it reached its production 1.37 million barrels of oil and condensate. And this is a record in more than 11 years. On the other hand, we have Nigeria. Nigeria is increasing its oil incredibly. And I think this is the big challenge for the OPEC Plus. The OPEC Plus now has to deal with its members first, how to manage the rising production coming from its members, and the other side, how to compete.
Is that still something of scale, Shoaib, that going into this meeting, that countries who have not complied are going to be held to account, or have they got their account in order before they meet? Because, there's been, the Secretary General has been going around and sort of hitting the stick a little bit on those countries. Are they reacting to the discipline required from OPEC, or are they going to go into this meeting also still violating their quotas?
I'm really sure there are very tough negotiations at the moment, how to control the OPEC members' rising production, and the other hand, how to control the non-OPEC production, rising production. The International Energy Agency released a few days ago released its paper saying that the non-OPEC production will be like, we increase by 1.5 million barrels by 25. So these are the main challenges for the OPEC, how to control the OPEC members, the rising production, and how to control the competition from non-OPEC countries. I think this is a challenging issue, and I strongly believe that if the OPEC Plus members or countries want really to control, stabilize the oil market, they have to change their policy. They don't need to rely only on crude oil. They need to invest in petrochemistry. This is the main factor.
Well, they're certainly all looking to future-proof their industry by going downstream into petrochemicals. Let's bring Russell Robertson, Chief Commercial Officer at the Gulf Mercantile Exchange, based out of Singapore. Russell, are we seeing any technical insights for the markets, the way they're being traded, the moved backwardation to contango? Is there any sort of cookie in the combine there that tells us a little bit about where the markets think OPEC's going to be going, where they think Russia and the Ukraine conflict might be going?
I would say that probably you could argue that OPEC has done a very good job, because markets are pretty stable, and we have seen obviously some geopolitical risk brought in, but ultimately we're very range bound. And I was expecting, probably just put as a personal opinion, it getting a little bit below 70 recently, and we haven't. We've bounced again. And that $70 number is really significant, because you can see a low there in beginning of December 2021, and we've had like 5 bounces off there, individual increments throughout the last few years, and we're holding it quite well, and we've bounced again. But interestingly, you see what we call the lower high each time that this happens, and the pattern on the chart, certainly artistically, looks to be slightly bearish. But I would argue that OPEC has done a good job. The market stayed above 70. They have kept a backwardated market. We've seen a little bit of contango recently in the front of the curve, but over the 12-month curve, it's still very backwardated, in my opinion. So, yeah, I would argue they've done a good job, and we're not really seeing too much. It's a very flat, sideways market. However, I suspect from speaking to clients in the last few weeks that sentiment's changing a little bit away from this very bearish China to not so bearish China. So I don't suspect that we're going to see a collapse in the oil prices next year. We may see a new range below 70, but it's not going to be a deep one, I don't think.
Adi, looking at that, where does demand go? Of course, we started 2024 with some optimism of demand growth, and that China would feature, as it always has. It's sort of like as reliable as the sunrise. They were going to consume 500,000 or 600,000 barrels a day more oil than they did last year. China ends the year, obviously the narrative disappoints, but still we have reports November this month they're importing over 11.5 million barrels a day. This is not by any means off a cliff stuff. How, as you go into 25, what do you think the sentiment should be vis-a-vis China demand and it underpinning OPEC's current market balance?
Well, when you look at pure market balances, as expected right now, they're not looking great for next year. First quarter next year, we are probably going to have big surpluses in the market. But I think with your first question this morning, I think you hit the nail on the head. There's so many uncertainties out there, geopolitical issues, and so on, that it certainly has been very, very supportive to the market. What is more is the fact is that everyone got a little bit too bearish. So the positioning, I think, was by at least the smart money was very, very short, and people realized, well, under certain geopolitical circumstances, that may not be the smartest thing to do. Now, am I bullish, particularly next year? Fundamentally, I'm not particularly bullish. I think China may turn out to actually have a negative growth this year in demand, but certainly next year it will pick up, whatever happens, because the government has no choice but either see these very, very poor figures or actually do something more about it. Election of Donald Trump as well. I think I'm sure it's been talked about to death. I don't want to add some more, but it's certainly adding additional uncertainties. What is going to happen with Venezuela? What is going to happen with Iran? What is going to happen with Russia? So these geopolitical circumstances are actually supporting the market. But other than that, China is not expected to grow that much. What is more, even India, which is that second sort of help that we always count on, is not going to be great. Because I was on a panel a couple of days ago being asked a little bit about Middle East. And China is still the key to demand. Because from the Middle East, about 6 million barrels of oil go to China, and about 2 million barrels go to India. If both countries grow by 5% next year, that's only 100,000 barrels from India and 300,000 barrels from China. So China remains, because of that sort of size, even at small numbers of growth.
But no matter where you go with demand outlook numbers for next year, I mean, putting aside maybe where OPEC and IEA might diverge, but ultimately the general narrative is that non-OPEC supply growth will be greater than any demand growth number.
Correct.
And OPEC Plus are in a quandary as they meet in 2 weeks.
Correct. So surplus, as I said, there will be a surplus next year. I think demand numbers that I would go with, realistic demand numbers, would probably be around 1 million barrels, maybe a little bit over 1 million, easily met. Again, I was talking 2 days ago with the head of trading at Petrobras in Rotterdam, and they're talking about more exports, more production, more investments. They're in for a long term. They are trying to focus again around sort of low-cost barrels. So, Nigeria is the same, as mentioned already by my colleagues. Everyone, all the oil producers are out there for the long run, and everyone is positioning for more exports. So there is plenty of oil out there. It's hard to get particularly bullish. But I do agree with Russell to the effect that I think the market got a little bit oversold, a little bit too bearish, I think. And with all the uncertainties, it's very hard to stay short in spite of some of the markets being contango. As far as the China is concerned that you've mentioned, let's not forget this is a time of year where China usually comes in and buys quite a bit of oil to stock up for the Chinese New Year. So I think that's what we're seeing right now. Some VLCCs of 40s and WTI Midland are going into China at the moment, supporting the market. So actually the front end Brent is pretty well supported at the moment. The market is not all doom and gloom at short term. Longer term, I think OPEC will just be forced to kick the can down the road. I agree with my colleagues. I think OPEC will just have to continue to cut. Otherwise, they would destabilize the market if they were to add a couple of hundred a month from now.
Shoaib, just on that point, I mean, we did have that famous sort of FT article in September indicating that OPEC Plus was willing to get into a market share war, were willing to add supply. And of course, that is the current plan, to add supply from January 1st. The 8 countries within OPEC that have made that commitment to extra cuts and now make that commitment to add supply back. Your thoughts on whether they may go through with that, even though the market will tell you, oh, prices will fall if you do that. Is there an argument to be made that they still will proceed with that? It's only 100 and something barrels a month, 100,000 plus. I think it's 180,000 barrels per day per month. Your thoughts on whether they could still go through with that decision, or will they postpone it again?
Yeah, I think we have discussed about these points before, and I strongly believe that the OPEC Plus members have to get back their market share, because if they did
That's your opinion. That's your advice to them.
Exactly, because let's see how historically in September they postponed to resume pumping the 180,000 barrels to the market, and we have seen what happened in the last few months, last few weeks. Libya is increasing production. United States a little bit, not too much. Guyana, Nigeria, Congo, many countries are increasing production, and that's a good market share for them. So if OPEC Plus made that agreement to resume, that could be something very good for them, I believe. And at the moment, with the U.S. Trump president just appointed CEO of Liberty Energy, the CEO of fracking service company. And as you say, Trump is all the time supporting drilling, increasing production. I think that market share also, if any gap in the market, will be filled by Donald Trump. I think this is the policy at the moment, how to get the market share. So I think the market share at the moment is something very important. And 180,000 barrels per day, I think it's not really too much, but at least the OPEC Plus members, I think they can dominate and take that share. This is the issue, I believe. And I strongly believe that the first quarter, second quarter of 25 will be very tough for oil prices. I think it will be very tough because we have many challenges. We have a glut of production and a glut of supply in the market. And if we'll have any gap in the market, one country could be in APAC, non-OPEC country, will fill up that gap. And I think the OPEC Plus members have to think seriously about this issue, and not only how to pump more to the market, but to think how to absorb the glut of oil in the market. As I said, to think about the petrochemistry. And ADNOC, as you know, ADNOC is in advanced negotiation with the Covestro in Germany, a giant petrochemistry company, to absorb that oil. Aramco also is negotiating. It's just reached the deal with the Sinopec in China to build a big plant of $10 billion just in the petrochemistry. I think these are the best ways to absorb the oil.
Well, these are
available in the market.
certainly a big sort of medium to long-term shifts
Exactly,
in the dynamics. Russell, in the more immediate dynamic of the sort of return of Trump, and the question that OPEC might be facing is how significant Trump, how effective the new administration will be in their declared intention to sort of lock in Iranian oil again, like they did in the first Trump administration, or maybe even go after other sanctions. But the question I have for you, sitting in Singapore, if you took out your binoculars, you could probably see a lot of the ships that are participating in that dark fleet, that are ultimately facilitating the movement of crude to China from Iran, etc. And so the question is, if Trump is to be effective in his policies, he's going to need, or would certainly be significantly assisted by the policing of the countries in your neighborhood. Is there appetite in Singapore, in Malaysia, and the Straits of Malacca countries to participate in closing down this sort of dark fleet, which is ultimately passing by your window every day?
Yeah, I can look out my window now and see the ships. I don't quite hear the music from The Empire Strikes Back or anything like that for sure, but it's there's certainly a number of boats out there. I think with Trump, to me, I try and take it back to basics, and everything I see that he's doing, and this is not a political comment, it's just ultimately inflationary, right? So spending money, and he does actually have a bit of a history, quite popular in the Middle East. So I've just come back from Dubai, and people were quite positive about him coming in, and ultimately the peacekeeping side of his negotiations, which leads to business. But he does seem to have that, and Iran will be part of that too. It seems that the narrative in the Middle East is you're going to expect to see some lines drawn in the sand. Whatever land has been grabbed in the last few years will probably stay as it is, but let's stop now. That does, to everyone's point today, lead to more supply. I'm not sure there's any appetite, particularly for people to go out there and close down the dark fleet. I mean, that's just part of the ecosystem now. And a lot of these countries we talk about in Asia, and the global south, if you like, are ultimately what we call swing buyers or swing producers. They look for arbitrage, and I don't think they're so politically focused as what they may think or what we think. And they just look for the arbitrage. I mean, India now got quite a lot of flow going in there from the Middle East, and I think it's called Suka. I'll quote you something someone said to me yesterday, actually. It's that we're having a recalibration of Asian oil demand, which you're seeing like Malaysia, China, not so much, but India, Indonesia, these types of countries are growing, and their demand is growing. So although it won't be the 5% of the total of China, it is definitely spreading out more across the region for oil demand.
So that was a long answer that said no in the end, more or less. That the appetite is not there to go out and.
Yeah, it's a very complex subject now, and
yeah, I know it is. I know it is.
When I look at the markets, it's the correlations are just moving all over the place. It's not an easy job for a trader these days, I must admit.
Well, we had yesterday on the show a shipping company and out of Singapore saying, I mean, basically that's what triggers my question, because that's what he said it would take in order for this challenge for the new administration to be in alignment with their desires. They would need the cooperation of those countries in your neighborhood. Unlikely to get it, would appear, unless they put the big squeeze on. That's the thing. How big a squeeze will they put on all of these actors who want this crude to flow? Let's go to the survey question today. which is looking at this original discussion point with Adi. How does the current oil price reflect the geopolitical risk to energy supply infrastructure? Seems about right. It's underpricing the current risk, it's overpricing the current risk, or it's significantly underpricing risk. That's the sort of question today, in a day after we saw some substantial escalation of the European war, and threats from Putin that this could go further. Or is this the last hurrah before the end as well? I mean, that's so. How is the current oil price reflecting geopolitical risk to energy supply infrastructure? 1, 2, 3, or 4. Take your pick there. We've seen the oil price climb over the last few trading days on the back of this escalation in Europe, now about $3 or $4, let's say. Is that enough? Is that about right? Will it go more? I suppose every day will have to take its cue. Adi, looking as we go into towards the end of the year, it is a year in which we've seen the divergence between OPEC, most notably OPEC research and OPEC reporting, and IEA, and we now at the end of the year, 1 month to go, and they're still about 1 million barrels apart. The relevance of that right now seems somewhat muted, but nonetheless, as we go into a new year, I reflect on this divergence. If it is to continue, is there a consequence for the market that this is such a significant gap? These major multi agencies that they are looking at things so differently. Does it disrupt the market? Does it give traders the wrong direction of travel? Your thoughts on that, how it impacted this year, how it could impact next year?
This, let's call it divergence, because it's quite a nice, mild term. It's purely political, Sean, absolutely political. And the reason is the following. It's nothing to do with forecasting whatsoever. We are in the early days of energy transition. And what's happening is that nobody can forecast demand in the next 10 years, because that forecast will always be purely function of government policy. Now, this is why it's political, because now the question is what government policy, what policy governments are going to take. And what hurts OPEC and many oil-producing countries is focus on net zero, because they know if the governments focus on the net zero and achieving net zero, that it will be self-fulfilling prophecy, and it will happen. So it is a political issue. It's basically people are saying, and OPEC is saying, let's forget about net zero, let's not even look at it. It's, all this, the climate change is real, but you know what? Let's not do anything about it because it's going to hurt them. But the fact is, the bottom line, if we want to zoom out, and I was at a conference this week, when you talk to the downstream people, you get a very, very different picture from the picture you get when you talk to the upstream people. And what you get is the fact that margins are really, really poor. In China, Sinochem just tried to sell 3 refineries. No, there was no bids whatsoever. Refineries are closing. European refineries are in deep trouble. Why? Because gasoline is peaking. Let's not forget OECD demand peaked in 2005. Now we see diesel demand in China, in India also failing. We have alternatives. Whether we like it or not, demand is peaking this decade, whether policies are right or not. And I think now we're going back to the market and what market is going. Market knows that.
If that is the case, and maybe we'll bring in Joib now because we're running out of time, but Joib, if that is the case that we are in this window of peak demand, and certainly in China, the narrative at least there's consensus around now that it's at least peak gasoline, diesel, sort of mobility fuels demand in China. But if we are in the window of peak, do you think, Joib, that gives wind to your argument that now is the time for OPEC Plus to reclaim market share, that this model of the last 30, 40 years of cutting to support the market, allowing others to come in and take market share, that is dies with the end of China growth, demand growth. Does that give, do you think, pause for OPEC Plus to consider?
Yeah, exactly, Sean. I think that the demand in China, growth of demand on oil and gas and natural gas in China, nobody can focus. Nobody can say that the supply will be like this in China, or the growth. But I have to say something. China is the kitchen of this world. So whenever any eases of any economy, for example, the European Union, Chinese will produce more, and when we say they produce more, they need more energy. Let's give you just one example of the EV, electric vehicle. So China now, let's say, it's dominating the globe with EV cars in many countries, and especially European Union. So whenever they need more cars, because Europeans at the moment, they need everything green, everything they need to electrify their energy, their sector. So they need more EVs. So if the Europeans request more EVs, more products, let's say clean products, they certainly come from China. And we can say if they come from China, China will require more oil, more gas, more natural gas. And that's why OPEC Plus has to take that market share, I believe. And this is a crucial thing for the OPEC Plus and even for China.
Well, let's give the last word to Russell. There is the seems about right is the consensus here, and that is where it's at. Russell, I wanted to just wrap out with getting an update from you regarding the sort of progress or the development, or if there's anything to update the listeners with Gulf Mercantile Exchange, now a few months into your new branding, your new existence, your new partnership, which brings you very deeply into Saudi Arabia. Obviously, that's the new partner to Tadawul. How has that impacted? What's it look like?
Sure. Yeah, it's been an exciting time. It's been a very productive few months with partnership opportunities, which is ultimately what we're looking at. This week we were in Dubai, and we issued an MOU with a company called Fast Markets, and that is ultimately to look at how do we develop metals in the region. So the futurization and commoditization of metals, particularly ferrous in Saudi. So that would be my big update for today.
And is that likely to be, I mean, that seems to be the big future narrative for Saudi in general, is minerals, minerals, minerals.
Yeah, people underestimate the sheer number of production and import and export of those items. So the way I'm looking at this personally is how do we bring together that trade flow? So there's a lot of trade flow. I'm not a great believer in just creating derivative products just for the sake of trading them. It has to have an underlining real economy solution, is what they like to call it in China now, the real economy solution. So that's what we're looking at. Yeah, there'll be more to come, but that's the one I can announce this week. Because
thank you. I think it's very useful to stay updated with that, and the other exchanges too, because of course they all reflect a maturing of the midstream ecosystem in the Middle East, and I think that's worth paying attention to. We'll wrap it up there. We end the session. Brent crude oil trading 74.28. Will the geopolitical tensions in Europe give more wind in the sails of this oil price as we go into the weekend? We'll have to wait and see. We thank, as always, our speakers, Adi Imsirovic, wonderfully to have your thoughts from London, Shoaib Boutamin from Algeria, and Russell Robertson from all the way over there in Singapore. Thank you, guys. Have a great weekend. All the best.
All the best.
Thank you.